On May 19, 2005, a pivotal moment unfolded in the world of finance when Michael Burry, a man with a keen eye for detail and a deep understanding of economic trends, sensed the imminent threat of a mortgage crisis. This wasn't just a hunch. After meticulously sifting through mountains of financial documents and data, Burry identified a ticking time bomb in the U.S. mortgage securities market, a realm once deemed as stable and trustworthy by many investors. Driven by a blend of greed and corruption, this market was on the brink of collapse, and Burry was one of the few who saw it coming. In an audacious move, Burry invested in his conviction by purchasing his first credit default swaps, betting against the mortgage market to the tune of $60 million across 6 bonds, each valued at $10 million. This wasn't gambling in the eyes of Burry. It was a calculated risk based on exhaustive research. However, it would take the world 2 more years to recognize the magnitude of the problem he had identified. By October 11, 2007, as the S&P 500 peaked at 1,576 points, few could foresee the drastic plunge that awaited. The market eventually crashed, bottoming out at 676 points on March 10, 2009, a staggering 57% decline. Burry's foresight turned into a monumental financial gain, netting him $100 million and securing over $700 million for his investors from this single transaction. Despite his success, Burry faced relentless skepticism and criticism from the investment community, including his own investors. Following years of proving his detractors wrong, and after achieving an astounding victory against all odds, Burry made the surprising decision to close his fund. Why do we revisit this story 15 years later? As history has a way of repeating itself, current trends in the financial market eerily echo the past, reminding us of Burry's visionary predictions. Burry's journey from detecting early warning signs in the subprime mortgage market to anticipating high inflation due to unprecedented money printing highlights his unique ability to see beyond the immediate horizon. He has consistently challenged the status quo, even when it meant standing alone against prevailing economic sentiments. For instance, Burry's early warnings about inflation following massive governmental stimulus measures were met with skepticism, only for him to be proven right as inflation rates soared to 8.6% recently. Michael Burry, with his unparalleled foresight, stands once again at the forefront of financial discourse, sounding alarms over a looming economic crisis and market downturn of potentially unprecedented scale. Drawing on his profound analysis of historical patterns and speculative trends, Burry projects a harrowing scenario where the S&P 500 might plummet by an additional 50% from its current standings. This prediction isn't based on mere speculation, but anchored in a detailed examination of past speculative peaks and significant shifts in market behavior, indicating a deep-rooted vulnerability in the present economic structure. Burry's caution extends beyond mere numbers. It delves into the intricacies of fundamental indicators and the subtle yet powerful undercurrents driving market dynamics today. He challenges the prevailing wave of optimism surrounding a swift economic recovery, suggesting that such narratives overlook critical economic indicators that signal a far more severe downturn. This perspective isn't just a contrarian view for the sake of dissent. It's a clarion call for investors to reevaluate their positions and expectations in light of historical precedents and the current economic environment. In doing so, Burry not only reaffirms his reputation as a visionary thinker, but also serves as a crucial voice of reason, urging the financial world to brace for a reality check that could reshape the economic landscape for years to come. Despite the market's temporary rebounds, Burry remains convinced that we are only at the early stages of a more profound crisis. He emphasizes that the historically significant market recoveries during bearish periods often precede further declines, illustrating the cyclical nature of financial markets. Moreover, Burry highlights the relatively low trading volumes in the current crisis compared to past downturns, suggesting that a significant market sell-off may still be on the horizon. Michael Burry's insights into the financial world are deeply rooted in the foundational principles of economics, emphasizing the critical interconnections between inflation, interest rate policies, consumer behavior, and overall market health. He posits that the inflationary trends observed in recent times, compounded by the strategic increases in interest rates as a countermeasure, have significantly diminished the purchasing power of consumers. This erosion of financial capability is not a standalone issue, but triggers a domino effect that can drastically alter the economic landscape. Burry foresees a scenario where reduced consumer spending, especially in non-essential or discretionary categories, directly impacts the revenue streams of businesses across sectors. This shift has the potential to lower company profitability, strain economic growth, and ultimately lead to a market adjustment or correction more severe than many anticipate. In his view, these dynamics could catalyze a pronounced economic downturn, challenging the resilience of businesses and the broader market. By highlighting these interconnected economic forces, Burry urges a cautious and informed approach to navigating the potential volatility ahead, underscoring the importance of understanding the broader economic indicators that influence market movements and stability. Michael Burry's uncanny ability to forecast market movements and economic trends is more than a display of financial prowess. It is a profound reflection of his insight into human psychology and the rhythms of economic cycles. Throughout various market conditions, from the dot-com bubble to the devastating 2008 financial meltdown, and now amidst today's volatile market environment, Burry has consistently proven that his forward-thinking predictions stem from an intricate analysis of economic data and human behavior. His contrarian views are not mere speculations, but are grounded in a thorough examination of economic indicators and a nuanced understanding of how greed, fear, and collective behavior influence the market dynamics. This approach has allowed him to foresee major financial shifts well ahead of the curve, distinguishing him as a visionary in the field. Burry's work underscores the critical importance of looking beyond the surface trends and understanding the underlying factors that drive market changes, combining economic theory with a psychologist's insight into human nature. His predictions serve as a reminder of the complex interplay between economic forces and human actions, offering invaluable lessons on the necessity of vigilance, thorough analysis, and preparedness in navigating the ever-changing landscape of the financial world. In an era where financial markets are increasingly influenced by short-term sentiments and speculative bubbles, Michael Burry's approach stands out as a beacon of critical thinking and foresight. His warnings may not always align with the mainstream narrative, but they serve as a crucial reminder of the importance of diligence, research, and a long-term perspective in investment decision-making. As we navigate the uncertainties of today's financial landscape, the story of Michael Burry not only offers valuable lessons from the past, but also underscores the need for vigilance, critical analysis, and preparedness for the future. In a world where economic trends and market dynamics are constantly evolving, the insights of visionary thinkers like Burry are more relevant than ever, guiding you through the complexities of financial markets with a blend of wisdom, caution, and an unyielding quest for truth.